You are listening to Mining Stock Education.
What you want to do is you want to watch for a spike in volume and the reversal in the stock, and that is usually a signal of tax loss selling being over in that particular stock. I had it happen to one of my stocks last week.
You are listening to MSE. I'm Bill Powers, and speaking with me today is my friend David Erfle from Junior Miner Junkie with a Y.com. David, welcome back onto the show for our monthly check-in. Hope you had a great Thanksgiving with your family. Since you were last on the show, we had a new president-elect, Donald Trump, and we've seen the markets, the gold price fall off a little. How do you see the Trump presidency affecting the overall economy, investing sentiment, and consequently gold and the miners?
Yeah, thanks for having me on again, Bill. It was a good Thanksgiving. I hope all your listeners had a great Thanksgiving too. Yeah, the gold price it went up from the end of October of last year to the end of October this year, 54%, almost $1,000, without as much as a 5% correction. So heading into the election week, it was expected to either have either a blow off type of short term top and then a reversal, or finally a correction of decent size of 5 to 10%. And I've been saying that. I was saying that in my column the previous weeks, and I was warning my subscribers as well, because you had the gold price had closed above its upper monthly Bollinger Band for 7 of the last 8 months. It had become extreme overbought, and look what happened. I mean, as soon as Trump won, and then it was viewed that he was that the Republican Party was going to have a clean sweep and control of the Supreme Court and all that, all the uncertainty came out, and profit taking was ensued. And this is a healthy correction now. And we had the gold price go up, like I said, almost $1,000 in 12 months. And then it corrected $280 in 13 days. And that's how the gold sector acts a lot, right? I mean, it takes the stairs up and then it takes the elevator down when there's a correction. So now we've got this $280 symmetrical consolidation triangle with 2450 on the right, 2450 on the 2550 on the bottom, something like that, and 2800 on the top, and it's consolidating now. Because basically, it's the geopolitical situation that's keeping the gold price well bid. Because I mean, with what happened in Ukraine, the Biden administration, right before they leave, they okay Ukraine to use their missiles to strike deep inside of Russia, and then Putin uses this secret weapon that flies at like 10 times the speed of sound, and it's capable of delivering a nuclear warhead. So the gold price is reacting to this, and yet the stock market, isn't. I mean, basically the stock market, especially the Dow, continues to make all-time highs because it's European money getting money out of the EU and putting it into Dow blue chip stocks. So the stock market isn't really reacting to the possibility of World War III or nuclear weapons being used over there. It's so the gold price is now on a big roller coaster ride. And as far as the Trump is concerned, I mean, Trump's first presidency, as soon as he was elected, the gold price, after having gone up quite a bit, it corrected 12% within 45 days right after he was elected. So before he actually became president later in January of 2017, the gold price corrected 12% in 45 days. But then once it bottomed, the gold price went up. I think it was like 65, 70% during his presidency. And these tariffs that now he's announced, that's the beggar thy neighbor policies of tariffs. It never work. I mean, it didn't work in the 30s. The Smoot-Hawley Tariff Act that just made the Great Depression worse. it brings on more inflation and it slows growth, which equals stagflation. And gold loves stagflation. So we got a lot going on here, and and this is before Trump has even taken control of the presidency. So what he says and what he's going to do are two totally different things. So I think the volatility is really going to increase here even more in December.
How do you see GDXJ performing relative to GDLD and the gold price?
Well, that's the thing, right? We saw the gold price go up to 2,800, and we saw GDX and GDXJ fail at multi-year resistance levels, and they started to sell off before the gold price started to sell off. So that was telling us, hey, the gold price is going to top out here, and silver was doing the same thing. So when you have silver and the miners leading gold, that's what you want to see. You want to see them leading gold higher. You want to see them showing relative strength. So you saw both silver and the miners showing relative weakness to gold before it really started to sell off. And that was telling us, hey, it's time, it's correction, it's going to be correction time in the miners from multi-year resistance. I mean, GDX had hit 4-year resistance and GDXJ 3-year resistance. And we had the miners go up in 8 months from February, go up 70%. And now they went up 70% in 8 months, and then they corrected 20% in 2 weeks, in 4 weeks. 3-4 weeks. So now we're having a consolidation there, and we saw the GDX and GDXJ come down to test their rising 200-day moving averages, and now they're basically, when they're bouncing up to downtrend, their downtrend lines, and they're selling off. And I think tax loss selling has a lot to do with that. Look, we had the stock market continues to go higher, and the miners have rolled over. So anybody who's down on any of the miners now are selling for tax loss and putting the money in the stock market. So we've got that to contend with here again. So the tax loss selling season, it usually ramps up the last few weeks of November, and that's when it starts to really ramp up, and then it starts to tail off in the middle of December. So this week and next week, we're probably going to see a lot of these stocks hit hard. But what you want to look at especially if you got a junior on your watch list, and you're factoring in tax loss selling, that the project is sound, the management's sound, they're doing all the right things, they've got a bunch of money in the bank. What you want to do is you want to watch for a spike in volume and the reversal in the stock, and that is usually a signal of tax loss selling being over in that particular stock. I had it happen to one of my stocks last week. We had thin trading conditions in the stock market during Thanksgiving holiday. I know it's not Thanksgiving in Canada, but it's still thinly traded conditions in both Canada and the U.S. all week last week. And yet one of my stocks had a huge volume spike and a huge white candle and went up 16% on no news. And I think that was basically the end of tax loss selling and value buyers coming in and buying the stock.
Dave, have you ever seen, in all your 20 years of junior mining investing, have you ever seen the bottom for tax loss for a junior be in November? Because usually, historically, like the average is around December 15th or thereabouts that you see the juniors bottom.
Oh, absolutely. Like I said, these things bottom, on their own. A bell doesn't ring and then all of a sudden the whole sector bottoms. Each one is going to bottom on its own, and it's based on what evaluations, what's coming up with a particular company as far as a major news release or maybe a major technical report. It could be a feasibility study that the market expects is going to be really good, but they're waiting for tax loss selling to get out of the way before they get in. And now with retail not being in the sector, pretty much still, it's the street that is maneuvering these stocks a lot. So they're going to come in when they feel that, hey, we think that it looks like this tax loss selling has ran its course here. This is a great valuation for this stock. They've got these positive news coming out that we believe is going to be positive. We already like the project. We're just waiting to get we're ready to get a really good entry point to start accumulating the stock.
Dave, you have a selling decision for one of your juniors in your newsletter, and I was thinking about the rationale for selling in that you said, when it gets back to my cost basis, then I plan to sell and move it into something else. Some would say, well, hey, if this is what Rick Roll says, if the reason for owning the stock is no longer there, you sell it immediately and then do something else with the money. Maybe talk through a little bit more of the rationality of why are you wait? What happened if it doesn't get back to your cost basis? Then is there opportunity lost?
Yeah, I mean, it all depends on what's going on with that particular stock at that particular time and the reasons why it's selling where it's at. I mean, if it's a company, there's a company that I sold for tax loss last week. And it was a company that I was waiting to get a little higher before I sold it. But the reason why I sold now is because there was a lot of warrants that are exercisable even below my cost. So my waiting time was going to be a lot longer. I still like the project. And it also looks like the company's going to need more money. Even though they just built a mine, there's, of course, it cost them more than they expected. And they're going to need more money. That they just announced today. I saw that they just borrowed the last few $1 million off of their credit line, which tells me they are going to need money real soon, and they're going to have to raise more money at a really low price, which is dilutes the stock even more and takes away more of the upside. So there's so many different factors. You take, if you're down 30, 40, 50% on something and you still have a lot of faith in the management team, it's the reason why it's lower. It's not because of what the company's doing. It's because of what's happening in the sector. Then I'm going to go ahead and hold on to it and wait, because I know the company is cashed up through the next year. I know they've got maybe a major PEA or a major PFS or a definitive feasibility study, or maybe they've already raised a lot of cash, and they'll be able to attract a debt package to start building to maybe start constructing the project, or maybe they're getting some permits, because you got to think about permitting also. I mean, a company could be, have a definitive feasibility study out or getting close to putting it out and being close to, hey, we're ready to start building, but oops, we're not going to be able to get fully permitted for another couple of years yet. And the street looks at that and they're like, oh, great project. It's going to get built eventually, but hey, they're not going to get their either their environmental permit. That's the key one, right? Once you get the environmental permit, then pretty much everything else falls into place after that. It looks like, wow, they're not going to get their environmental permit for at least another couple of years. So why should I even bother investing in this stock yet?
So I had a CEO tell me that the Lassonde curve is no longer the Lassonde curve, because especially like in the US, that trough after exploration, it's so long, it flatlines for too long, decades even.
Yep. Yeah, it's such a totally different market than it was when I got into this sector 20 years ago. I mean, we didn't even really think about permitting back then. Permitting wasn't really an issue. There was these ESG issues didn't exist as much as they're in focus right now. So there's so many more different factors you gotta think about, and it turns a lot of people off of this sector. Even though there might be a lot of money to be made in particular stocks, they don't even want to deal with it right now because, hey, look, AI stocks are doing great, crypto stocks are doing great. The Dow just hit another all-time high, right? And of course, that goes back to tax loss selling that I talked about. I mean, even if you got this great stock that you've done really well in, it's starting to roll over. And anybody who got into it late, they're thinking, okay, I'm either going to take my profit now because the sector looks like it's rolling over here, or I got in this thing too late. I got to sell for tax loss. So, and then, but on the flip side, a lot of these companies have already been sold for tax loss over the past 5 or 6 months. So that's where a lot of the opportunity lies, in a lot of these companies that are optionality plays. that have great management teams. They got the access to capital. They're in a great jurisdiction. They've got this fantastic project. They're in a later stage. They've got a district scale size land package that it's on. The share structure is still pretty good, but the stock is being hammered because maybe they haven't got their permitting is a little farther out. But if you got the patience and you believe in the management team and you believe in the project, then go ahead and buy and get an entry position right around this time when you're looking for those things that I told you about when you see the share price spike. I mean, when you see the volume spike and the share price maybe reverse and go up, and you see something all of a sudden happen with the stock in relation to large volume when there's no news. And that is a sign that, hey, it looks like the tax loss selling is dried up, and it's probably a good time for maybe to just throw a little money at this and hope and basically sit on it and wait for the sector to come around, and B for the gold price to finish this consolidation and start to move higher again, because we're in a long-term bull market. I mean, in the gold price, and that's it's making higher highs and it's making higher lows, and it's outperforming the stock market. The gold stocks were outperforming the stock market for a little while there, but if you take a look at the volume is still not there, telling us that, hey, retail is nowhere near this sector yet, and that presents the opportunity where how long are you willing to wait if you're going to go ahead and start nibbling on these things? You just have to be a good stock picker. You have to get the right ones to wait in. Because if you wait in the wrong ones, you might get over diluted and your upside is dwindled away while you're waiting.
One genre of junior mining company that you're invested in is fully permitted, fully financed to production junior miners. How confident are you in those stocks that you're invested in right now?
I mean, I have 3 of those in my top 10 right now. And my biggest concern on these 3 positions are they're going to get taken out too soon. One is their project is so good they were able to get fully financed a year before they're even expected to get their environmental permit. So that one I'm not worried about it getting taken out too soon, because I don't see a major coming in and taking out a company right now that that's not shovel, that's not that is that far away from being shovel ready.
You also invest at times in West Africa. I had Joe Mazumdar on the show recently. He's avoiding West Africa right now with some of the security risks with Mali, arresting mining executives, holding them hostage, and how that's going to increase the cost of capital. Even though you can permit there, it's geologically endowed. You have no problems with West Africa right now, Dave?
It depends, on the country. One of my biggest winner this year is, and it's in my top 10, Montage Gold. They just got a fully financed package. They got access to close to $1 billion to build their project, and they're in Cote d'Ivoire, which is one of the lower risk, high risk West African countries. But they're bordering on Burkina Faso, right? So even though the company is in West Africa, which is considered higher risk, the stock has done really, really well. My subscribers and I just sold a third of our position to get our original investment capital out. We're just holding the rest, and this is one of the ones that hopefully it doesn't get taken out too soon by a major.
There is a definition of risk that says risk means more things can happen than will happen, and so when you apply that to like the due diligence we do, like say on a pre-production or even a production company, there's so many things that can go wrong. Recently for Contango Ore, a stock that's traded on the New York Stock Exchange, they saw a 25% increase in their all-in sustaining cost. Therefore, the stock price fell off. And David, has to do with too much moisture in the ore, which means the trucks are too heavy.
I should have saw that coming.
The trucks are too heavy, so the bridge toll price has gone up dramatically. Who would even know?
And this is a company that's got a super tight share structure, right? Which is these super tight share structures, they could be a positive or they could be a negative. When it's negative news, the stock gets hit even harder because it's a super tight share structure, right? And when it's super good news, it goes up a lot higher than usual because it's a super tight share structure. So yeah, I mean, that's why I never put any more than 5% of my investment capital in my junior portfolio into one company. I don't care how good it looks. I mean, it's in my experience in this sector of over 20 years now, it's the companies that you say, okay, I'll take a flyer on this, and it looks like it should do pretty well. The management team's good, whatever, and I like everything, but it's got a few bugs. Those are the ones that are usually the ones that are home runs for you. And then the ones that you look at and, this one, it ticks all the boxes. This is a no-brainer. This one I know is going to do really well for me. It's usually those that end up not doing so well for you. So that's why I never put any more than 5% into one company. And then I have these rules also. Like I said, there's one of the rules that just came into effect. The stock tripled. It became 15% of my junior portfolio. So it's time to trim it. It's time to take a third of the profits and get my original capital out of the stock. And so now I'm holding it risk free. Basically, and my subscribers and I are holding it risk free. So I have these rules in place that I've learned over the past few decades, and I don't alter. I don't alter my rules on anything. I mean, I've done it before where I've had these rules in place before I had the newsletter. And this one, I think I'll just go ahead and deviate from my system here a little bit. And it bit me in the ass. So actually, it's a good thing that happened, because that taught me, don't deviate from your plan, because your plan works. It's time tested. You've made a lot of money in this sector. Sure, you've left a lot of money on the table, but that's going to happen in this sector. Like you just brought up. I mean, there's so many factors that you couldn't even possibly look ahead to see. Like, I mean, moisture in the ore going over the bridge is gonna bring up costs. I mean, and then Contango, I think, I'm not sure of this, but I think they only own like 30% of the project too. I think Kinross is the operator and they own 70%.
Right. Yeah. They ship the ore to Kinross, and then Kinross processes it at their mill.
Right.
Yeah.
Yeah.
So what you described, Dave, in terms of your winners, it's like luck, the factor or the input of luck and randomness to your disciplined approach, right? That's what you're describing.
Right. I mean, it's a lot of this in this a lot of it's luck, but you just got to put yourself in the position to be lucky. At the same time,
and minimize the position of being unlucky, possibly, right?
Right, and minimize your risk. Right, to have if you're just getting into this sector, it is important for you to invest, in a newsletter, that it's going to teach you these rules, these rules that you need to have in place for yourself. And my newsletter does that. I know there's a few others that basically my newsletter is a teaching platform. I'm not, don't subscribe to my newsletter if you just want stock picks and me to tell you that this is a great company and it's going to go to the moon and you're going to make a lot of money. I go over all the basics. I give you the macro, I give you the geopolitical, I give you everything that's moving the gold price each week. I give you the technical analysis of each company. I go through every single press release and break it down for you, what it means. I try to give you a heads up on what's happening in the sector. So, a newsletter like that is something that you want to invest in if you're a newbie in the sector, because, I invest my own money in all these companies. I don't take any money from any of these companies. I don't take any warrants. I don't take any options. The only money that I make is from my trading ability and my subscription fees. And the article that I write in Kitco also, I don't take any money from Kitco either. I'm sorry this turned into a sales pitch for my newsletter, but it's not just my newsletter. There are several others out there that do what I do also. So, when I first got into this sector, I subscribed to a handful of newsletters. And basically that did a great job of teaching me how to eventually start my own newsletter 20 years or 15 years later.
Did you buy most of the stocks you were presented with, Dave, or how did you as a consumer utilize those newsletters?
In the beginning, I did, right? But then I learned from not only my mistakes, I learned from the newsletter writers' mistakes also. So if you invest in a newsletter, that's also another great reason to have a newsletter subscription, because you're also learning from their mistakes. And if you're learning from their mistakes and your mistakes at the same time, then it helps you to be a better investor in this sector, because there's so many red flags you got to look out for that the newbie investor doesn't really look at, and especially in bear markets and juniors like we're in right now. In a bull market, you just pretty much throw a dart and you can make money in the junior sector, and that's what happened when I got into it, right? And I just all of a sudden I thought, wait, I'm a genius. I'm making all this money, and then I look back on it and I say, my God, look at the things I invested in, and I actually made money on them. Now I wouldn't touch them.
And you limit your subscriptions to 500, and there's open room because it's still kind of a bear market.
I average around 300, and that's about where I am right now. But
but it's been closer to 5, right? A couple of years ago when gold was hotter.
When gold was hotter and the stocks were doing better, it was. But you got to watch the stocks. The stocks and silver will tell you when gold will bottom. The stocks and silver will start to show relative strength consistently first before gold bottoms. And it happens at tops and it happens at bottoms. That's what happened at the top at 2,800. We saw silver and the shares start to roll over. And Newmont's surprisingly bad quarter that consisted of higher all-in sustaining costs was a big reason for that. So when you have the largest gold miner in the world showing that its cost had risen from $1,450 an ounce to $1,611 an ounce, all in sustaining costs, that's not good. And it happened to Barrick as well. So you had Barrick and Newmont, which is 20% of the GDX. They disappointed the market on all-in sustaining costs. That their all-in sustaining costs were a lot higher. Their stocks got hit harder. So that's why the GDX got hit so hard, because the GDX, like I said, they're 20% of the GDX. So it's not really a good barometer for the mining sector, because it's so overweighted in these two stocks. But the third one, the number 3, Agnico Eagle, they had a fantastic quarter. They're the best gold miner on the planet as far as I'm concerned. I also own it in my retirement account. They continue to make all-time highs with the gold price. So you've got Agnico Eagle continues to make all-time highs with the gold price, and you've got Wheaton Precious Metals. They're the best royalty play, because they're the best royalty company streamer. They continue to make all-time highs with the gold price, and then mid tiers, you got Alamos Gold. They're doing the same thing. They continue to make all-time highs with the gold price. So there's not that many miners that are doing that, which is a big reason, because of these costs. They're having a lot of these miners are not doing a good job controlling their costs, but they've done a great job of fixing their balance sheets. So they're paying dividends, they're paying down debt. I mean, miners, they've never been this healthy since I've been in the sector. I mean, when I first got in the sector, miners paying dividends was unheard of. And now they're buying back shares, they're paying dividends, they're making loads of cash on their margins. Some of their margins are near 50%. So but when you got a stock market that continues to go higher, and it's the most overvalued. The stock market's the most overvalued it's been since the dot-com bubble. I mean, PE ratio in the dot-com bubble is about where it is, a little higher than where it is right now. And you've got, as far as sentiment's concerned, sentiment is the highest it's been since the dot-com bubble. So you've got a stock market that is overvalued and continue to go higher, and you've also got a gold price that continues to go higher. but you've got the miners are still being ignored because they're viewed as too risky, and they're having a hard time controlling their costs. And then juniors, I mean, people figure, why should I bother investing in juniors if
when
I'm
you could buy
doing so well
Bitcoin?
in Bitcoin and AI, right? Exactly. So it's a very niche market, and it's going to continue to be a niche market until the stock market rolls over in earnest, and funds and big money players and retail investors start to, where should I put this capital? This bubble's burst. The stock market's rolling over. Look, it's finally over. I've got to do something with this. And here's our tiny little sector that's depressed and massively undervalued to the gold price. And it's tiny and it doesn't take much. So that's why we continue to wait. We know it's coming. Bubbles always burst. They always pop. So, Trump's economic policies might just do it. I mean, I really think, unfortunately, that it's a bad place to be in, where you're hoping for the stock market to roll over before your sector does really well. But that's just the way it is.
David's website again is juniorminerjunkie, spelled with a Y.com. Dave, always appreciate chatting with you, and let's speak the first week of the year after the new year.
Looking forward to it. Have a great holiday season, everyone.